Good afternoon, and thank you for joining us for Rivian's second quarter 2024 earnings call. Before we begin, matters discussed on this call, including comments and responses to questions, reflect management's views as of today. We will also be making statements related to our business, operations, and financial performance that may be considered forward-looking statements under federal securities laws. Such statements involve risks and uncertainties that could cause actual results to differ materially. These risks and uncertainties are described in our SEC filings and today's shareholder letter. During this call, we will discuss both GAAP and non-GAAP financial measures.
Hello, everyone, and welcome to Kilowatt, a podcast about electric vehicles, renewable energy, autonomous driving, and much, much more. My name is Bodhi, and I am your host. And on this episode, we are going to talk about Rivian's Q2 2024 earnings call. And normally, we would start off with RJ Scaringe, founder and CEO. We're going to start off with his opening remarks. But honestly, RJ said nothing of consequence in his opening remarks. So we're going to move on to CFO Claire McDonough because she actually said some things that I thought were useful. So let's go ahead and jump into Claire's opening remarks.
During the second quarter, we produced 9,612 vehicles and delivered 13,790 vehicles, which represented the primary driver of the $1.2 billion of revenue we generated. As expected, second quarter production was impacted by plant downtime associated with the retooling upgrade. Our deliveries were strong as we sold through the majority of inventory of our first generation R1. Due to strong Q2 performance, which led to our lower starting finished goods inventory balance and the continued ramp of production throughout the third quarter, we expect our third quarter deliveries to be below our second quarter results and production volumes to be in line with our first quarter levels. Total gross profit was negative $451 million. Our gross profit loss per vehicle delivered was approximately $33,000, which includes approximately $15,000 of depreciation and amortization expense and $1,200 of stock-based compensation expense. In addition, we incurred approximately $2,400 per vehicle delivered in the quarter related to our cost of revenue efficiency initiatives, which we do not anticipate being part of our long-term normalized cost structure. We expect to see significant cost reductions in our R1 platform during the second half of 2024 as we ramp the production and deliveries of our second generation R1 vehicles. Additionally, the reduction in our LCNRV write-down for the quarter compared to Q1 2024 reflects the progress we're making in association with our material cost reductions and operational efficiencies associated with our second generation R1 vehicles. We remain confident in our path to deliver modest positive gross profit in the fourth quarter of 2024 and for the full year of 2025. Importantly, our team is already focused on driving incremental cost out of our R1 platform to help achieve our long-term gross profit target of 25%. The key drivers of our long-term R1 profitability include reducing material costs, leveraging our fixed costs, and scaling our revenues per delivered unit through product mix and pricing, software and services, and other revenues. During the second quarter, we also announced the intention to form an equally controlled and owned joint venture with the Volkswagen Group to create next-generation electrical architecture and best-in-class software technology. In association with this deal, Volkswagen Group have made an initial investment of $1 billion into Rivian, with up to $4 billion in planned additional investments for a total deal size of $5 billion. The incremental investments are subject to the completion of definitive agreements, the achievement of certain milestones, and the receipt of regulatory approvals. Assuming all criteria are met, we expect that the full $5 billion is intended to flow to the benefit of Rivian. In addition to the $5 billion of capital to Rivian, we anticipate incremental benefits through cost savings on materials, operating expense efficiencies, and future revenue opportunities associated with the joint venture. The initial and planned investments by Volkswagen Group, in addition to our cash equivalents, and short-term investments, are expected to provide the capital to fund Rivian's operations through the ramp of R2 and Normal, as well as the midsize platform in Georgia, enabling a path to positive free cash flow and meaningful scale. As RJ mentioned, we expect the deal to close in the fourth quarter of this year, and we will provide additional details at that time. During the second quarter, we improved our cash flow from operations by 41% as compared to the first quarter of 2024. This improvement is reflective of our continued focus on cost and greater working capital efficiency across the business. As compared to the first quarter of 2024, we reduced our gross profit loss per vehicle by approximately $6,000 and made progress on reducing our gross inventory balance. We believe these trends will result in further improvements in our cash usage for the second half of 2024. As we look ahead, we are reaffirming our 2024 production guidance of 57,000 units, delivery expectations of low single-digit growth as compared to 2023, EBITDA guidance of negative $2.7 billion, and capital expenditures of $1.2 billion. As a reminder, coming out of the retooling upgrade, we are currently operating the R1 line on a two-shift operation, which results in 56,000 units of annual run rate output. Our commercial van line is currently running on a limited one-shift operation, which has the potential to deliver a run rate annual output of 15,000 units. As we look ahead for 2025, we expect that our Normal facility will not be producing vehicles for more than 1 month during the second half of the year as we upgrade and integrate new equipment into the plant ahead of our first half of 2026 R2 launch. We continue to see a clear path to long-term approximately 25% gross margin target, high teens adjusted EBITDA margin target, and approximately 10% free cash flow margin target. I wanted to again thank our team, partners, customers, suppliers, and shareholders for the tremendous support. With that, let me turn the call back over to the operator.
Thanks, Claire. I prefer to call myself a host. However, I'm not going to get all upset about you calling me an operator. I'll be fine with it. I don't have much to say on Claire's opening remarks. I thought they were useful. When we go into this earnings call, a lot of what was asked about was their joint venture with Volkswagen. And I put some clips that I thought were helpful in this episode. But a lot of it was like, hey, we're not ready to talk about that. We'll talk about it at the end of the year. Sounds like the joint venture will be finalized sometime in December of 2024 is the vibe that I got. Normally, there's like a theme to the earnings call. And honestly, I felt like the theme to this earnings call happened to be the Volkswagen Rivian joint venture. And again, I think there's 2 clips that I left in there where I thought it was useful. But beyond that, they just didn't really want to talk about it, which I understand why. So let's go ahead and jump into our first analyst question.
Our first question comes from George Gianarikas with Canaccord Genuity. You may proceed.
Hi, good afternoon, and thank you for taking my questions. Maybe just to start, can you just please talk about your geographic strategy, particularly in Europe, in light of the recent VW relationship?
Thanks, George. As it stands today, the R1 products are being sold throughout the United States and Canada. And our EDV products are primarily our commercial van products are primarily focused in the United States, but we have made some deliveries in Europe and specifically in Germany. Now, with regards to our future products with R2 and, of course, R3, those have been developed really at their core to fit not only the U.S. market, but to also fit the European market. And you can really see it as you look at the R2, R3 combination of what we believe capturing a sweet spot in terms of both addressing demand for midsize SUVs in both U.S. and European markets, but also with R3, capturing a smaller crossover market. And so, as you've heard us talk about many times, this is one of the things we're so excited about with the R2 platform is just the growth in the addressable market for us as a business.
I don't think it's a big surprise that the R1 platform isn't destined for Europe. The R1T is not the biggest truck that you can buy here in North America, but it's still a pretty big truck by European standards. And the R1S is a really big SUV. It's not to say that you couldn't own one or drive one around in Europe. It's just to say that it would be difficult in certain situations, right? I did find it interesting that the delivery van was being tested in Germany. I didn't know that, so that's pretty cool. And that also leads us to our next question about the electric delivery van and testing it with other companies outside of Amazon, or I should say, other than Amazon.
Our next question comes from Philippe Houchois with Jefferies. You may proceed.
Yes, good afternoon. Thank you very much. Couple of questions for me. One is very little mention of EDV in the release. Could you give us an update on how your customer trials are going on and might have a kind of an idea of when you might have first customers outside of the Amazon deal?
Thanks for the question, Philip. The EDV program is something that for us is we're really excited about. The impact of it in terms of reducing carbon emissions on a per mile basis is outstanding over internal combustion vehicles. And we've been able to really prove the robustness of the platform and the strength of the offering through our relationship and partnership with Amazon. And having a large deployed fleet of these before we started running the pilot programs we've talked about in the past with non-Amazon customers was really helpful as we refine not just the vehicle, but also the software surrounding the vehicle. And so as we've talked about in the past, we're over the course of this year, we've been running pilots in anticipation of more significant ramp up in 2025. And this focus on pilots is really reflective of the nature of this business, where these are large decisions around large numbers of vehicles for a lot of these bigger fleets. And it's appropriate that we build effective working models for how the vehicles are serviced, what digital support the vehicles have, what infrastructure changes are necessary for each respective fleet. It's a lot different than adding a single charger in your garage when you buy an R1. When you're thinking about adding many chargers and a lot of new power into, let's say, a fulfillment center, a distribution center, or an operating center. If you're a business that's running 20, 30, 40, 50, maybe 100 plus vans out of it. So these are great learnings that we've been driving off the basis of what we put together with Amazon. And we are looking forward to starting to talk about other customers beyond Amazon.
I would imagine that having an electric delivery van or a fleet of them is a kind of like a mindset shift. You have to shift your mindset to do that as a fleet operator, right? If you have one or two that you're testing, probably not a big deal. But if you have a whole fleet of them, you have to figure out where you're going to charge them. You have to figure out, how far they can go, what routes they can do reliably. You have to figure out how to track them. There's a whole bunch of stuff that goes into that. And, every delivery van company or every fleet operator, I should say, because this doesn't have to be a delivery van. It could be plumbing vans for that matter. Every fleet operator has a different set of needs. And for Rivian to have a solution for each of those needs, it probably isn't easy. And that, like I said, that includes charging and maintenance and repairs and the fleet software, the whole bit. I would imagine that there's quite a bit more that goes into that than one would think. Next up is one of those questions that I was talking about the VW investment. So let's go ahead and listen to that.
I wanted to go to the VW investment and wondering, from the fact that you got this money in what I think many of us consider to be a more sort of efficient manner than going through the capital markets. What does this allow you to do from a product plan or capacity perspective that previously wasn't, on the table if you were going to be fully reliant on the capital market?
A really important part of what this deal represents for us is it really eliminates a lot of the risk that was seen around our balance sheet and allows us to focus the launch of R2 still using our normal facility. But as you've heard Claire and I both talk about as part of our Investor Day, not only have the balance sheet to support launching R2, but also the balance sheet to support taking us through positive cash flow. And we recognize the importance of that focus on driving efficiency into the business, both in terms of how we operate the business, but also in terms of how we deploy capital from a CapEx point of view and an investment point of view. And the organization is hyper-focused on driving towards profitability and hyper-focused on the launch of R2 and what that represents for us in terms of the scaling that comes with it.
So it sounds like there's a few really positive things, and I'm just going to oversimplify this, right? Rivian and VW engineers are working together still while the joint venture information, details are being hammered out. So Rivian gets to talk to experienced VW engineers, and VW engineers are working with those Rivian engineers. So they're solving a problem from different viewpoints. Rivian is also able to see, let's say, motivated suppliers, because if Rivian is developing this technology for Rivian, they're only selling a few, tens of thousands of vehicles a year right now. But if they're able to do this with Volkswagen sells a lot more vehicles, which means that Rivian's going to get a better price. Volkswagen's going to get a better price. Rivian can jump on that and get those same parts probably at the same cost that Volkswagen's getting it at. So it's lower cost for Rivian. It gives them that lifeline, that $5 billion that they'll have access to get the R2 up and running. This is a good question. This is a good answer. Now, I don't remember if everything that I just talked about was in the clip, because again, this question was asked several times. I might have been piecing some things together. So if I said some things and you're like, that wasn't in the clip, the reason why is because that's probably an amalgamation. I made notes while I was listening to this. I didn't go back and listen to every clip while I'm recording. So that's why. If you're like, that wasn't in there, that's why. Let's see. The next question is, what is affecting the R1 line currently at the plant? And when I say the plant, I mean the Normal, Illinois plant.
Our next question comes from Joseph Spak with UBS. You may proceed.
Thanks. Good afternoon. RJ, maybe you could just dive a little bit more into what is exactly happening in the plant and what's impacting the R1 line, R2 work doing next year. And then Claire, can we expect that the R1, given that most of the changes are already done, can ramp back up pretty quickly, so we could understand the shape of gross margins next year? Because it sounds like you guys are planning for maybe some sequential improvement until that downtime, maybe a downtick in the third quarter and then a recovery in the fourth quarter. I just want to make sure that's we're properly calibrated there.
Sure, Joe. Yeah, so as we think about the operations next year, this is looking at 2025. We've said we're going to be taking the plant down for roughly a month while we make some of the changes necessary to integrate the R2 production into the plant. Some of that work has already happened. We did some of the preliminary work in the most recent shutdown in conjunction with the move from Gen 1 to Gen 2 on our R1 platform. But the shutdown that's going to happen in the second half of next year will make the splicing together of certain parts of the plant possible. That's part of our plan. We'll be working around that, but as we did with the Gen 1 to Gen 2, we wanted to provide very early guidance around this and make sure expectations were appropriately set for what will have to happen in the plant next year to integrate R2.
And then based off of the second part of your question is as well, given the shutdown, there will be some choppiness to the financial results as we look through not just a quarter sequential improvement in our results as we look at the gross margin trajectory. As I mentioned in my prepared remarks, we still maintain that we'll have a modest positive gross profit for the entire year of 2025 in particular, but certainly with the shutdown itself in the second half, we'll feel some of the impacts of lower absorption of labor overhead and depreciation like we experienced in Q2 of this quarter, given the lower production volumes that we had in the normal facility itself. But to RJ's point, more akin to the November shutdown that we had to do some of the pre-work for our Q2 shutdown, we were able to get right back up to line rate based off of the aftermath of that shutdown. So we expect we won't see as sort of staged of a ramp back up from a production standpoint, given the fact that we'll have already ramped up our supply chain, which is one of the gating factors as we've gone through the course of ramping up new technologies in our redesigned Gen 2 product.
Yeah, that makes sense to me. Don't have a lot to add to that. So let's go ahead and hit our next question, which has to do with demand trends since they refreshed the R1 platform. And then there's a brand question in there as well.
Our next question comes from Ben Kallo with Baird. You may proceed.
Thank you. My first question is more near term. Just RJ, if you could talk about demand trends you've seen since the refresh, and then my second question, brand is important to everyone, but to you guys, you've done a good job of building a brand. Can you talk to us about how you measure that internally, or any way that you can put context to how you built your brand and how that extends to future models? Thank you.
Yeah, thanks, Ben. Ultimately, our Gen 1, our first set of products, the R1, was our handshake with the world, and they were received really positively. This was 2 years ago, and it was exciting as we introduced the Gen 2 of our R1 products to see how strong the media reaction was to those products, and recognizing we took a great vehicle and made it even better. And that is something that we saw echoed across a variety of different media outlets, from lifestyle to automotive to more pure technology outlets, but recognizing the strength of what we built. And that really serves as a wonderful foundation for the continued growth, as you put it, of how we're building and developing our brand and how we're perceived. And there's lots of ways for us to measure that. We certainly look at things internally. We have a whole host of internal metrics that we track regularly. But I think important for for the analyst and investor community is to look at ways that third parties would look at our brand. And most recently, actually, coincidentally, JD Power does a number of ways where they look at the strength of a brand or the strength of a product offering in the market. And we've in the past done extremely well in this, and most recently in their annual appeal study that looks at a combination of vehicle performance and its overall packaging. We came out number one, and that's the number one rated brand in their study. And to do that after having had previous number one performance in previous years is really exciting, and it's incredibly encouraging, and we think bodes really well for what's to come with R2. If we can carry the same brand strength and the same market share penetration that we have at the premium segment, where we're continually one of the best-selling vehicles over $70,000 today in the U.S., if we can take that market share strength and brand strength and apply it with our R2 product into the sub $50,000 price category, with R2 starting at $45,000 and R3 pricing not yet announced but going to be lower than R2, we're really bullish on what that represents in terms of volume, but importantly, answers a real need in the market where there's I'd characterize as a pretty severe gap in product choice for great, highly compelling EVs under $50,000.
I don't know that if he answered the question about the demand after, can't remember exactly how it was, demand trends after the refresh, but he really talked a lot about the brand question, and that's something that Lucid seems to be struggling with. I don't think Rivian is struggling with this issue. Rivian is a company that a lot of my friends who are not in the world of EVs, they know Rivian. They might know Lucid as well, but I would be willing to bet that if I polled my friends, they would know that Rivian offers a truck and they offer a big SUV. I don't think that they would know that Lucid offers a car and is coming out with an SUV soon. And to be fair, I don't think they would also know that Rivian's coming out with a smaller, more affordable vehicle. But amongst the people that I hang out with, who are just normal everyday folks that they don't care about EVs, Rivian is a known brand, whereas Lucid maybe not. And if they do know Lucid, it's more known as like that upper end luxury $260,000 Sapphire Air brand. Like, I still run into people when we're talking about Lucid who think that car costs $260,000 or even $160,000, which is a lot of money, and even the base price is still a lot of money, but it's around $69,000 at its base. Not a lot of my friends can afford that, but and not a lot of people can afford that. $70,000 for a vehicle is a lot of money. But I think Lucid's brand or their branding as an outdoorsy type company makes them more approachable. Whereas, and I think I said Lucid, I mean, I think Rivian's branding as an outdoorsy company, good for camping and going off road and that kind of thing, I think that makes them seem more approachable, even though their vehicles, are still pretty spendy. Whereas Lucid is considered a luxury brand, and even Lucid said that they wanted or hinted at wanting to have an off-road type vehicle in one of their mid-tier EVs that they're putting out. If you missed it, they're releasing 3 EVs to compete with the Model Y, and one of them could be an off-road vehicle with like what the R2 is doing or Rivian's doing with the R2. I don't think Lucid is going to find that to be a very. I think they're going to have a hard time convincing people that the luxury brand can go off road. Like, if you're looking at a Range Rover, right? Luxury brand can go off road. You're not looking at like Maserati as a luxury brand, but also could go off road. I think that's gonna be a harder hill for Lucid to climb. And I think Rivian comes across as more approachable, even though they're still pretty expensive vehicles. Next up, we're going to hear about regulatory credit sales. And actually, I thought this was a really good question and a good answer. It seems like on the surface it would be boring, but I thought it was really good.
Our next question comes from Shreyas Patil with Wolfe Research. You may proceed.
Hey, thanks a lot for taking my question. First of all, curious what you're seeing in terms of opportunities in the sale of regulatory credits. I appreciate it can be lumpy with $17 million in the quarter, but are you seeing growing opportunities to sell reg credits at this point, just given some of the struggles that we're seeing with the legacy OEMs?
And Claire referenced it, just in regards to our top line in terms of revenue. But the regulatory credit environment is certainly very strong right now. And practically speaking, that means we have the potential to generate more revenue around our credits market than what we'd originally planned or anticipated. But I think more importantly is the fact that the credits market is so strong is a reflection of I'd say the decision that we see a number of companies that are going to be investing less into electrification or have less product in electrified product across multiple segments and across different price points. And so that void of products actually creates this strong credit environment. And for us, I think the most important read through is the demand environment we see, coming into 2026, 2027 is going to be very, very advantageous for us, where there's a lot of latent demand. There's a lot of demand that's sitting, waiting for the right type of product, the product that has the right form factor, product positioning, attributes and features. But folks have been sitting, waiting for that product to show up, but haven't seen it, so they continue to buy an internal combustion vehicle or continue to buy a hybrid vehicle. We see this really large pool of demand under the surface that's just waiting, and we believe waiting for something that's very much like what an R2 is.
Companies like Ford and GM, who were gung-ho on EVs. We're going to have this many EVs by 2020. A lot of companies, Stellantis said that. A bunch of companies were like, we're going to have all these EVs by 2020, and they're all going to be better than Tesla. And then it turns out it's really hard to build an EV, and it's really hard to make them efficient, and it's really hard to sell an EV. So Ford and GM have not gone away from EVs, but have pulled back a little bit and hedging their bets with hybrids and that kind of thing. But what that means is they are, there's targets here in the United States that they have to reach. And I'm sure there's maybe targets in Europe in terms of environmental or air quality targets that they have to hit. And buying these regulatory credits allows them to sell their polluting vehicles and still hit their goals, or whatever targets have been set for in the government world. So that leaves companies like Lucid, Tesla, and Rivian, all electric vehicle companies, in a pretty good position to sell regulatory credits. So I would imagine that this is a pretty good business to be in right now. Will it be a good business forever? I don't think so. But right now, it seems like a way to make a little extra money, especially when you consider they're already doing it. So it's just an added bonus on top of what they're already doing. All right, next up, we're going to hear about integrated software and hardware. This question and answer has a little bit to do with the Volkswagen joint venture. So let's go ahead and listen to that.
Okay, great. And my second question is, in thinking about your software architecture, one of the defining elements is that it is almost entirely built in-house, from the baseline operating system to the middleware, hypervisor application layers. You've talked before about legacy automakers not really having this level of vertical integration, so clearly this is a big competitive advantage. But with VW now able to access the software platform, I'm curious how you think about the long-term advantage in software. Do you still see potential to maintain an edge here over most legacy OEMs, even those that may want to replicate your approach? Or do you feel that the industry will eventually catch up and essentially this is now an opportunity for you to monetize this asset and help the industry make the transition to software-defined vehicles?
There's a few ways to speak to this. I think first, before we get to product differentiation or customer-facing advantages, building a network architecture and associated electronic stack that allows for significant consolidation of ECUs and therefore simplification not only of the number of ECUs but also of the harness and associated wiring, infrastructure within the vehicle. That creates meaningful cost advantages relative to a traditional platform, which will have, call it 50 to 100 ECUs within the vehicle. And so we've talked about this. Our Gen 1 vehicle had 17 in-house ECUs. We reduced that down to 7. And so it is a significant multi-$1,000 structural cost advantage to have a network architecture and topology of computers that's far simpler and far lower cost than traditional approach. So first and foremost, there's a real cost advantage. Now, of course, our partnership with Volkswagen will extend that cost advantage into their respective products as well, and bring with it, scale and volume, which will in turn allow us to source those components and systems at a lower cost. But from a consumer-facing point of view, what it represents owning not just the hardware, but owning the software and owning it around a really optimized architecture, as I described, is the ability to continue to make the software a lot better. So the features can not only become more rich and more robust, but they can truly improve more than just surface level skins on, let's say, your cluster or your center information display, but into deeply into the vehicle and changing the way the vehicle performs dynamically, changing the way its charging profile set up, changing battery management system characteristics, so you can have the vehicle get better and better and better over time in a way that's very difficult when you rely on third parties to produce this complex labyrinth of ECUs and all the associated software, where even small changes require coordination amongst many different players. And so things that can take us minutes can take months for a traditional approach. And so all that being said, what the customer experience is, of course, beyond the vehicle performance and the way it drives and behaves, is what they see, that the digital environment. It's also something that the UI framework, the approach to digital design, the approach to user experience design, is something that we've spent an enormous amount of time on, and we believe will continue to be differentiated and is facilitated and enabled by our platform, but it requires both. And we hope that by bringing this strong platform to our joint venture with Volkswagen, it allows them to have to create products that are also really compelling and answer some of the points I made before around there is a real lack of choice. I would characterize it as like a pretty extreme lack of consumer choice around EVs and products in the space. And in order for us to really scale towards 100% electrification, we need to have more than just a couple of highly compelling vehicles. There needs to be essentially mirror the amount of choice that we have in the combustion world, which we're not even remotely near in the EV space today.
Again, I thought this was a great question, great answer. The thing with the legacy OEMs, I don't think it isn't that they don't know how to do this or that they don't want to do this. I think they just have a lot of legacy technical debt that is right now just too expensive to buy themselves out of. Like they have to do a lot of redesigning from the ground up to do this kind of thing, and I think they'll get there. I just right now, with the F-150 Lightning, for instance, the F-150 Lightning shares a lot of the same components as an F-150 ICE version. I am sure that there's some technical debt in the F-150 Lightning that's left over from the ICE version that does not make that software hardware integration as seamless as what Rivian and Tesla and Lucid have. Like the advantage of sharing a lot of those same components was they were able to build the Lightning, or at least the initial versions of the F-150 Lightning, at a much more affordable price because they already had relationships with the suppliers and they already had a really good price on those components. Unfortunately, when it comes to that software hardware integration that you would really need for an EV, it's just not always there. And I'm talking like I am guessing. I'm giving you this example as a guess and using the F-150 Lightning as an example. But yeah, initially it was probably great because it was a cheaper vehicle to build in the beginning. Long term, you have that technical debt, and what are you going to do with it? Next up, we're going to hear about Rivian Spaces, which is where people can go and, find out more information. It's a storefront for Rivians.
Our next question comes from Ron Jusikow with Guggenheim Securities. You may proceed.
Yeah, good evening, and thanks for taking my questions. RJ, you've talked in the past about as Rivian opens new spaces, order intake in those geographies accelerates. I know you've laid out the plan to 2025 for spaces, but is there any way to think about what is launching in the coming quarter or the second half of this year, just to think about demand being an important part of your bridge to gross profit in the fourth quarter?
Yeah, so we have, as you called out, we have a number of spaces that are going to be launching over the next 6 to 12 months. And those spaces are great ways for consumers to get a chance to experience our vehicles firsthand, to sit in them, to touch them, and play with all the features. But beyond just our spaces, we've also really over the last 6 months begun activating our service infrastructure to support expansion of our demo drives program. And so we have over 60 service locations that month over month, quarter over quarter, we're growing the number of those locations that do more than just service. And they not only provide service, but they support test drive and demo drives, as well as, of course, delivery and other sales-related activities. And then beyond our spaces, our service infrastructure, we're also continuing to build out our Rivian Adventure Network. That's our DC fast charge network. And that's another touch point for customers to experience the brand. Today, that network is close to being for Rivian only. But later this summer, we'll be opening our network up, so it'll allow non-Rivian customers to use the network as well, which is a great way for folks to experience Rivian as a brand and get exposure to the products and get exposure to us as a company.
Okay, so we're running long on time, and I don't have anything to add that RJ didn't already say. So I'm going to go ahead and end it here. I want to thank everybody for listening to the show. If you went and checked out the Beyond the Post episode that we did on Daily Tech News Show, thank you very much for doing that. I really appreciate it. If you left feedback for them, thank you very much for doing that. I really appreciate it. If you want to support this show, you can go to patreon.com/kilowatt or supportkilowatt.com. And you can become a patron, or you can go to Acast Plus and support the show that way financially. All of the money goes back into the show. None of the money goes into my own pocket. So the goal of the Patreon is for it to pay for the day-to-day operation of this show. And we're getting close. We're not quite there in terms of the show making money, but we're getting close. The show, if it makes money this year, it's going to be very, very little. The advertising money and the Patreon money all together don't amount to a whole lot, but everything put together, it helps. Whereas before I was paying for this all on my own, I don't have to do that anymore. So thank you very much to the patrons for supporting the show. And if you want to do that for as little as $1, the benefit is you get all of the ads taken away for all the episodes. So $1, you get an ad-free experience. All right, everybody, that is it for me because my voice is going. In the last 4 days, I think I've recorded 4 podcasts. I might have recorded 5. I might have missed one, but yeah, my voice is toast. So I'm going to take a couple of days. I'm going to rest. You will hear from me on Friday. Thank you so much for listening, and take care. Oh, and I'm going to end the show with RJ's closing remarks.
Yeah, thank you everyone for joining us today. We're really excited with the progress we're making, the transition to our second generation R1 vehicles and the associated cost structure that drives both at the bill of materials level, but also within our operations, within our plant, is a really important stepping stone for us as a business. And the efficacy through which that launch occurred really reflects the growing capability for us as a business. I'm also really excited to see how customers have continued to react to the product, and seeing how favorably this second generation R1 was seen and continues to be seen. Really sets up well for us with what's to come with R2, where R2 leverages a lot of the content, particularly around the network architecture, the ECU topology, the software stack, and even beyond that into some of the componentry architecture that we've laid out with the updates to the R1 platform. So again, thanks everyone for joining. We're looking forward to continued progress and continued efforts on our drive to profitability, and look forward to speaking to everybody soon.
Thank you. This concludes the conference. Thank you for your participation. You may now disconnect.